So we came from the summer into the autumn thinking that the yields at the back end of the curve were set to release cheaper. We had favored steepening curve trades over that period. But now that move has unfolded, we think it's largely behind us. The long bond actually overshot levels where we thought that would get. So the 30-year bond, 335 to 338, was the area in which we thought the market would start to establish the cheap end of a new range. It actually overshot and got closer to 345. That said, like I said earlier, this is an area where we think the market establishes the cheap end of a range, the move largely behind us. The steepening bias that we came into the autumn with, we've since exited those trades, and we're actually already fading the yield curve with full flattening type trade strategies.
So let me get this straight, Jason. You said the steepening bias with which we entered the autumn. I mean, it's barely, the first week of October now. I mean, we're, October 9th or so, and we've seen the steepening for the season that you anticipated.
That's right. And what we had highlighted in our 2018 outlook, we expected this bear market in bonds to play out in somewhat of a similar way to the last Fed tightening cycle from 2004 through 2007. And basically what you saw at the back end of the Treasury curve is the Fed slowly raised rates at the front end. The back end saw a stair-step type pattern, mostly range-bound price action, but that was punctuated by very sharp, acute moves to higher yields at the long end. There was very short-term periods that yields actually rose, though. So we ultimately think that move's already behind us, like I said.
So, Michael, what sorts of sectors do well in this sort of rate environment that we have now? I don't know if you concur with Jason in terms of having seen the bulk of the steepening already. But given where we are right now, what did the chart show?
Yeah, I do agree with him. I think that the way this probably plays out is that the Fed might move the short end more rapidly than the long end goes up, which means your yield curve stays somewhat flat, sort of like it was in the 1990s. Now, in that environment, then you've got rates that are gradually trending higher. So don't get pulled into this trade recently where people have moved to utilities, they've moved to staples, they've moved to the interest sensitives. I don't think that's the right trade because I think that yields will gradually move higher. It's just the flattening yield curve. Now, that draws into center, your center attention would be the financials. The financials have had a big run because the yield curve did steepen. If you go back and look at the financials historically, they've had virtually no correlation to the 2 10-year spread. This year, that correlation's jumped to 93% with an 86% R squared. So they're pretty much tied at the hip. So they've been underperforming as the yield curve flattened. We jumped, and the financials have responded. If Jason's correct, and I do agree with him, then I would be reluctant to chase the move in the financials as well, because I do think we get back to a more flattening type trend for the yield curve because the Fed raises the short end longer than or faster than the long end goes up.
So, Michael, you see the worst case scenario as another 3 to 4% down from here for equity prices. What is the probability of that as opposed to other scenarios that you might handicap?
I think it's kind of low, and when I put that worst case scenario in there, what I'm looking at is obviously the sentiment, the strong economic growth, the earnings growth, but then I'm also looking at the technicals. And to get to that 3 to 4% down move, we're going to have to get to some really good technical support. And the ultimate downside, which is 4% from here, which would be a total decline of about 5.8%, which is normal for an equity market, is the 200-day moving average. Now, when rates jumped in January, we held the 200-day moving average in January. We retested it in March. We retested it in April. So I feel comfortable that in the current environment we're in, that that's as bad as it would get. I don't really think we get there. I like the way the market's trading today. You've got a full workforce back from the Columbus Day holiday. You look at the bond market's rallying now. The yield curve has flattened just a little bit. Tech stocks are bouncing back. People are seeing some value there and coming back to that area. So I kind of like the way it's transpiring at the moment. But there again, we're in a seasonal pattern. We have the trade issues. We have the market refocused on Italy. Right. The market's refocused on bonds. So it's good that people are worried. And in that environment, you could have some quick sell-offs and a resumption of downside. But I think that we hold, 200-day in a worst case scenario.